Hello and welcome to yet another episode of Weekend Investing series. And here we look at past data and we try to draw inferences from that data that can give us insights for the future of our markets. And today's data is about how markets double from each point, and from here on, by when will markets double? So we're not trying to predict anything. It is just a data exercise where we'll study what is the past data and how has markets done in the last many decades and what is likely to happen with what kind of probability and what should be your readiness for that kind of scenario. So let's dive in. So we are taking Sensex data because that is more uh, available from 1980s onwards. And this is a 3 monthly chart of Sensex for the last 30 odd years. And you can see how consecutively every decade the index has moved up. Of course, there was a big lull here and some lull here, but the trend is very much on, and we are near 85,000 on the Sensex. So if we were to double from here at 1,70,000, it sounds like a enormous figure. But if I were to point out on this chart itself that we were at 43,000 or 42,000 just right here, less than 4 years back. So if I were to take you back in time and say that imagine that you were in 2020 or 2021 and Sensex was 42,500, could you have imagined that by 2024 Sensex would be double from there? At least I could not have imagined that. Or if I were to go back further and look at maybe 2014-15 and say that in the next 10 years will Sensex go up 4x? It was tough to consider that because the previous 5 years Sensex had not gone anywhere. So, the recency bias tends to kick in and you say, okay, I'm happy with lesser, but I don't think 4x is possible in 10 years. So this has been an amazing run here, just like we've had some amazing runs before 1990, before the GFC. So there may come a lull, but let's see what the numbers are saying. So no predictions, as I said. Let's dive into the data. We want to see where we will reach 170K, whether it's going to be 2, 4, 6, 8, 9, 10 years, whatever it is. The months that have been taken to double in Sensex, if we go back in history, has been this chart. So from 2020, it took 74 months to double. And then as markets went into that lull, it took 18, 20 months to double from, and this is monthly data. And then GFC happened and it took 143 months from there. And then when the crash came from the crash bottom, it took only 17 months to double. And then once we had the high point of 2011 or 2010, it took 110 months and it has been dropping steadily since then. From COVID bottom, it took only 18 months, and uh, the last point is 45 months. So we've exactly from October 2020, we are now in September end 2024. So about 45 months it has taken to double. So this is the uh, trajectory of doubling in the last 20 odd years. So you can see that, on an average, somewhere between 40 to 60 months is where we have been doubling so far. If I see that occurrence in terms of a bar chart format, you can see that 60 to 70 months is where the most occurrence is, 21% of the times. But then there is a significant percentage at 50 to 60 and up to 90%. And then there is some occurrence even in 20 to 30 month period. And there are some which are really, really long, but very low periods of occurrence there. Uh, so 72% probability is that it may take more than 50 months if we take this part of the chart, 4 years and 2 months. So that is a significant probability. 72% of the times it will take more than 4 years and 2 months. You also have a 6% probability that it may take more than 100 months, 8 years and 4 months. That has also happened in the past. And 28% probability that it may take less than 40 months, which is 3 years and 4 months, which is exactly what has happened in the recent past. Uh, and if I go to the extreme, then just 20% probability that it takes less than 2 years and 6 months. So it has also happened that a doubling has happened in less than 20 months also. But between 10 and 30 months, there's a 20% probability. So the quickest doubles come only after a crash, and that's pretty obvious that once market crash, the doubling from there usually will come the fastest. So of these 253 months, there were 50 months where the doubling happened in under 30 months. So let me just rephrase that. So out of these 253 months that we are studying, there were 50 months where if you invested, you doubled your money in under 30 months, 2.5 years. And which were those 50 months? Uh, it's it's a perplexing data, I would say. Uh, you will not be able to guess how many of those 50 months were before 2009 and after 2009. I thought there'll be more before 2009, but I did not know that almost all of them were before 2009. So 49 of those occurrences happened before 2009, and only one occurrence since COVID crash came after 2009, where market doubled in under 30 months. So you can see that there has been a complete shift of market dynamics before 2009, so before GFC and after GFC. This is extremely perplexing data, actually, to for me at least, that the market has, you know, gone much more smoothly post 2008 crisis, 2009 crisis, and prior to that, there were many crashes, many doublings, many crashes, many doublers, and it has been a very stable market post that. Now there is a concept of the worst doubles, so which has taken the most amount of period. So 100 months and more, 8 years and more for doubling, and there has been a 6% probability of that happening. And that all of those were in this period where the markets were about to peak. So July 07 to May 8, this period is the sort of the worst doublers, where it took uh, more than 100 months for doubling. Now, the period after 2009, we neither had quick doubles nor have we witnessed worse doubles. So it has been the most steady phase of the last 30 years, which have been the last, you can say, 15 years. So first 15 years, extremely choppy, I would say. Lot of crashes, lot of doublings from there. Next 15 years from 2009 onwards, uh, more mature, more steady. Just one COVID crash, that's an external crisis that came through. So what now? So pace of doubling has mellowed down, that is for sure. We are yet to witness a rally like we did in Harshad Mehta time, or we did in post.com crash or the GFC rally. While we've had a COVID rally, post-COVID crisis, but it pales in comparison with what we saw in, let's say, 1992, or even the dot-com boom. So the CAGR achieved in each of these doubling rallies, if we see uh, from each month, what was the CAGR taken to double in Sensex, then you can see that if you were in, let's say, 2008 crisis, uh, it took 60% CAGR to double from there. And if you were, let's say, in a normal period, it took 10 to 12% the normal CAGR to doubling for. So an exponential phase has not been seen for a long time, where the CAGR taken to double continues to go up. And that has, so you can see that since um, uh, 2008, it's been very, very sharp, except mellow, except the sharp dip in the COVID crisis. So certainly markets, you can say, they are heated, but not to the extent that which we used to have in periods of the prior runs. I mean, it is up, but not as much. I mean, even if you see the trajectory is gradually going up. Yes, this small peak up that we have right now looks a bit exponential, but other than that, it has been very, very linear. So if we were to apply the same probability as before, and it could be right or wrong, that's not a question of prediction. There's a 28% chance we'll hit a double in 4 years, or less than 4 years actually. So maybe by 2028 end, we may get to the doubling of 170K on Sensex. That is possible. And there is a 65% chance that we will hit the double in this bracket between 2028 and 2033. That is also possible. And there is a 6% chance that we really don't do so well and we hit the doubling by 2033 onwards. Now, the fact remains that past performance cannot predict future performance. The fact also remains that India has never been in a spotlight like we are today on the global map like before. The fact remains that India's demographics, the number of amount of people coming into the workforce, the amount of consumption story that is spanning out, the amount of you can say positive approach or positive review by global fund managers. All that is looking very, very good. So it is almost like a, I shouldn't say, but it's been repeated many times. It's a Goldilocks scenario where everything is looking to be just to be falling in line as you would have wanted it. All investors are doing well, whether it is real estate, whether it is gold, whether it is bitcoins, whether it is equities, all are doing all right. There is sufficient flow of liquidity that is happening. Yes, FIIs off and on have reallocated, but domestic liquidity has also been coming. And FII liquidity, at least in the month of September 2024, has been phenomenal. 50,000 crores has come in. So all that is pointing towards there is a good probability, I think, that we do it within the first two brackets and not the third one. Um, there is also the question of irrational behavior. So while we think that markets are irrational, they are more than 25 times earnings or whatever, maybe the earnings ratio right now. Um, one thing that you must also appreciate is that there is something called the scarcity of supply. While there is demand that is coming through, that everybody wants to buy stocks, are there enough stocks to be offered to them of of the kind that they want to buy? And if there are not, then the ones that are, you know, good businesses will be bumped up to irrational pricing. So if you see, for instance, FMCG counters, Levers, Nestle, Britannia, Dabur, Marico, all these have been irrationally priced for the last 15 years. Colgate, uh, other names, even in banking, HDFC. I mean, if you compare them to global banking or global FMCG price earnings ratio or any metrics that you find, you will find that Indian metrics has been irrational for a very, very long time because there is no other option. If people want to buy a good quality FMCG stock, I mean, there are only these 8 or 10 stocks and everybody wants to buy them. So they are priced that way and the demand always continues every year. The price remains there. So that can also happen to overall markets, that if everybody wants to come in, but there's not enough paper, there's not enough supply, then the entire market will be boosted up. If everybody, let's say, if currently we are getting 1 lakh crores of money coming in from outside and that suddenly becomes 5 lakh crores, then what will happen? The market will just continue to be irrational for a long period of time till somebody wants to take out money. So this, the same thing what this Coldplay concert has happened. The 20,000 rupee ticket has gone to 1 lakh and even 5 lakhs or whatever, because there is demand and there's only limited supply. The same thing happens to Bitcoin, same thing happens to gold. There's only limited some 60 meters by 60 meters by 60 meter cube that gold has ever been mined, or there are only so many Bitcoins in the existence. So when on one hand, a lot of money keeps getting printed, and on the other hand, there are only limited things to invest in. So obviously, everything will go up, and that is exactly what is happening in the world today. So the probability of doubling in less than 50 months seems lower because we are already at a trajectory which has gone higher. But we can't really underestimate the power, of gushing liquidity. And the liquidity that we have today is very, very strong. Uh, the uh, the historical perspective on this, if I were to sort of see this, is that earlier liquidity used to go from one asset class to the other. So stocks used to go up and then they used to come down, and money used to move into real estate. Real estate used to go up, it used to come down, it used to go into gold. This kind of behavior has stopped happening. So now everything is up. So even if somebody wants to take out money from any asset class, where do they go? If you made money here and you come to real estate, I mean, people have already made money there. So I mean, everything is not is in a, a sort of a irrational territory, if you call it. So if everything is irrational, then there's no point moving, right? So you can only jump from one stock to the other, maybe if you find that one is worth more. So you have to ensure that, good asset allocation is there, because if you are solely in stocks, then there may come a time where, this 9-year period of doubling may also happen, and then that will hurt your compounding. So you need to have a strategy that is adaptive, that is self-repairing, that has ability to ride winners and losers. That is very, very essential, especially in these kind of markets where some irrationality is there. And we have to embrace downward markets as and when they come, because they are part and parcel of this journey. It is almost like saying that I'm driving a car and I will not stop to refuel. Um, if you don't stop to refuel, your car will die on the road. So you have to stop to refuel, and then continue your journey forward. How long that refueling time or that line will be is a different matter. But that's how the markets will go. And I hope that you will embrace all that is sent to you by the markets. So this is all I have for this particular episode. I hope you're liking this data backed series. Do send us your comments, and I'll see you in the next one. Thanks. Bye bye.